Markets are complex ecosystems, constantly reacting to a myriad of influences. Understanding how significant events translate into market movements is fundamental for both seasoned investors and aspiring financial professionals. This analysis delves into the primary categories of events that shape market behavior. Economic indicators are the pulse of the financial world. Gross domestic product, inflation rates, and employment figures provide critical insights into the health and direction of an economy. Positive data often signals growth, potentially leading to higher corporate earnings and a bullish market sentiment. Conversely, weak economic reports can trigger investor caution, leading to market downturns. For instance, unexpected spikes in inflation might prompt fears of interest rate hikes, impacting bond yields and equity valuations. Employment data, particularly non farm payrolls, can significantly sway market expectations regarding consumer spending and economic stability. Central banks, such as the Federal Reserve or the European Central Bank, wield immense power over financial markets. Their monetary policy decisions, especially regarding interest rates, directly influence borrowing costs and investment attractiveness. A rate hike, for example, can make bonds more appealing relative to stocks, potentially causing equity markets to decline. Quantitative easing or tightening measures also profoundly affect liquidity and asset prices. These actions are designed to stimulate or cool economic activity, and their announcements are closely scrutinized by market participants for clues about future economic conditions and investment opportunities. Geopolitical developments introduce significant uncertainty and volatility into markets. Wars, trade disputes, political instability, or major diplomatic shifts can disrupt supply chains, alter international trade flows, and impact investor confidence. Such events often lead to a flight to safety, with investors moving capital into perceived safe haven assets like gold or certain government bonds. The immediate market reaction to geopolitical news can be sharp and unpredictable. Long term impacts depend on the duration and resolution of the event, often reshaping global economic alliances and investment landscapes. Technological advancements are powerful drivers of market change, creating new industries while rendering others obsolete. Innovations like artificial intelligence, biotechnology, or renewable energy can lead to significant reallocations of capital. Companies at the forefront of these disruptions often experience rapid growth and increased valuations. Conversely, sectors failing to adapt face declining revenues and market share. Investors must continuously assess the disruptive potential of new technologies to identify emerging opportunities and mitigate risks in traditional industries. Large scale natural disasters or global pandemics can have profound and immediate impacts on markets. They disrupt economic activity, strain supply chains, and alter consumer behavior. The COVID 19 pandemic, for example, triggered unprecedented market volatility and a global economic slowdown. These events often necessitate significant government intervention and fiscal stimulus to support economies. Their long term effects can include shifts in industry structures, increased focus on resilience, and changes in investment priorities. Understanding the interplay between these key events and market reactions is crucial for informed decision making. While no one can predict every market movement, a robust analytical framework allows investors to better anticipate potential impacts and adjust their strategies accordingly. Continuous learning and adaptability remain paramount in navigating the dynamic world of finance.